For years, the Schwab U.S. Dividend Equity ETF, you probably know it as SCHD, it's been an absolute fortress for investors. Steady, reliable, safe. But here in 2025, that fortress is showing some pretty serious cracks. So today, we're going to put on our detective hats and figure out what is going on. Why is this beloved ETF having such a tough year? Let's dive in.
And really, the whole mystery boils down to this one simple conflict. On one hand, you've got the fortress, SCHD, right? Built on a solid foundation of quality, dividend-paying companies. But on the other hand, you've got the rocket ship, the 2025 market, just blasting off, fueled by AI, crazy growth, and pure momentum. They are playing two completely different games right now.
And that brings us to the core problem we're here to solve today, the safe bets paradox. How on earth did a seemingly foolproof formula for conservative investing just suddenly start to fall apart? The very things that made SCHD a fan favorite, its discipline, its defensiveness, well, those have become its biggest liabilities this year.
And I mean, just look at the numbers. The performance gap it's staggering. While the S&P 500 has been soaring up over 12% this year, SCHD is actually down, somewhere between 5 and 7%. That's a nearly 20-point difference. That's not just lagging, that's getting left in the dust. So what's really going on? Let's dig into our first clue.
Okay, clue number one. It's all about the market's complete and total obsession with artificial intelligence. And look, this isn't just some small trend. We're talking about a massive tectonic shift in where investors are parking their money. It has completely changed the entire landscape.
And check out the sheer concentration in the market right now. It's wild. Just 7 companies, the Magnificent 7, your NVIDIAs, your Microsofts, they make up nearly 30% of the entire S&P 500. These are the rocket ships we were talking about. And SCHD, well, because of its strict investing rules, it holds basically none of them. This bar chart really shows you the structural problem perfectly. The S&P 500 has over 30% of its weight in tech, which is this year's big growth engine, but SCHD, it's dramatically underweight, with only about 12 to 14% in tech. It's basically sitting on the sidelines during the biggest party in the market.
So the crucial point of our first clue is this. SHD is built to be a disciplined value investor. It's hunting for fair prices and steady, reliable cash flow. But right now, we are in a die-hard growth investors market, where big, exciting stories about the future are being rewarded way more than solid present-day value.
All right, let's move on to clue number 2. And this one shows how government policy has created a really powerful and kind of unexpected competitor for all those income-seeking investors that SCHD usually attracts. Okay, here's the second major headwind, and it's a big one. As an income investor, why in the world would you take on all the risks of the stock market for a 3.7% yield from SCHD when you can get a higher yield, 4.5%, from a U.S. Treasury bond with basically zero risk? For a lot of people, that choice is a no-brainer. This intense competition from high-yield bonds has completely wiped out something called the dividend premium. That was the extra amount investors were willing to pay for reliable dividends from stocks. Well, with that premium gone, poof, billions of dollars have just poured out of dividend funds like SCHD and gone straight into bonds and money market funds.
For our third and final clue, let's turn the magnifying glass away from the market for a second and focus it right on SCHD itself. It's time to pop the hood and examine the fund's own internal DNA to see what's holding it back.
So when you actually look under the hood at what SCHD owns, you find a portfolio of really high-quality companies. But just look at the headwinds they're all facing right now. Home Depot is getting hit by a slowdown in the housing market. Texas Instruments is dealing with cyclical softness, which is just a fancy way of saying demand for their non-AI chips is in a down cycle. These are solid, great companies, but they just aren't producing that explosive growth the market is rewarding right now.
And the reason it holds these specific stocks all comes down to its own strict rulebook. See, SCHD follows this rigid, rules-based index. It screens for stuff like a long history of paying dividends and having a quality balance sheet. And while that's super prudent for the long term, it means the fund is structurally unable to chase those hot growth stocks, and it rebalances way too slowly to catch big momentum swings. It's designed to be slow and steady. So, we've looked at all the clues, right? The market's obsession with AI, the tough competition from bonds, and even SCHD's own internal makeup. So now it's time to deliver the final verdict and really understand what this all means for the long haul. This quote just perfectly captures the verdict.
SCHD was never, ever designed to be a flashy racehorse that wins every short-term sprint. No, it was built to be a reliable workhorse, steadily pulling that cart of wealth compounding year after year for decades.
So the bottom line is this: SCHD isn't broken. Its underperformance isn't some fundamental flaw in its design. It's just temporarily out of sync with a market that is, for the moment, completely drunk on momentum and speculative growth.
And hey, if you need proof that the workhorse strategy really pays off in the long run, here it is. Over the last decade, SCHD's slow and steady approach turned a single $10,000 investment into more than $28,000 with all the dividends reinvested. That, right there, is the power of compounding.
So what's the key takeaway from all this for you? Well, first, just because the market goes through a crazy cycle, it doesn't mean your sound, long-term strategy is invalid. Second, diversification always matters. Even the best funds are going to have off years. And finally, successful dividend investing is a mindset. It's all about having the discipline to stick with the plan, especially when it's not popular.
And we'll leave you with this final thought to chew on. The market's obsessions, they always change. The speculative beat of today will eventually fade away. The real question is, when it does, who are the ones that will be left standing, quietly and patiently compounding their wealth for the long term?